this town hall in Santiago. Thank you for making the time to come over. It's very good to see familiar faces, not only amongst the members, but also from the broader stakeholder community. So welcome for that. Now, before I move to focus on the broader risks the insurance sector faces, I'd also like to thank Matt for the interesting insights to the challenges of the evolving cyber landscape, particularly given his perspective as a cybersecurity vendor to small companies. Now, these risks will continue to play an important role in our work on operational resilience and within that, cyber resilience in the coming years. Now I'll move to the broader risks. A lot of us, while we were being cooped up at our homes, stuck on Zoom or Teams or WebEx in 2020 and 2021, we're all hoping for some light after coming out of that tunnel. But instead, and as we heard from the Minister, Mario Marcel, and the Deputy Governor of the Chilean Central Bank, Pablo Garcia, the economic storms, not only in Chile, which appears to have been having some respite very recently, but globally appear to be darkening. So I don't want to depress you, but it is the truth. So I would like to set the IAIS's work within that context. Now, why do I say that the clouds have been darkening? We have seen the Fund, the OECD, the World Bank, all downgrade the global economic outlook and have witnessed the impact of unprecedented market reactions with a significant tightening of monetary policy and other actions. Economic and market factors mean that insurers are likely to see increased credit and market risks as the outlook becomes more downbeat, illustrated, for example, in terms of credit risk, by spreads and corporate debt, which have been widening and have become more volatile. Now, inflationary pressures are not all bad news for all of the insurance industry. There actually could be good news for the life sector, but they're not so good for the non-life sector, and they're countered more generally by claims inflation. I mean, what is quite important in this particular area is that, the insurance industry has lived through other inflationary events accompanied by recessions, but not for many years, particularly in the advanced economies. So the question is, do the people who make the decisions in these companies know how to deal with these type of risks? And that is important. What I'm worried about is liquidity risks increasing as markets adjust to the economic outlook and the new market dynamics, and particularly as we seem to be observing market events, shocks that are beyond the usual historical experience. I mean, we experienced some of this in the United Kingdom with the long-term government bond yields moving way beyond what we had seen historically in terms of one-day moves. We experienced that in the globally, for example, with the moves that we saw in the nickel market. Again, historically never to be seen. And a lot of these events, if they combine with leverage, can create liquidity risks. What happens, what is typical with these events, is that liquid assets turn illiquid. And as a result for that, if you are leveraged, and a lot of leverage these days is collateralized, either because it's in the form of sort of derivatives, or it's collateralized leverage, and that means that you've got to margin your loans with assets that have fallen in value, which then can create all sorts of bad spirals. So that is happening, and what is also happening is increased geopolitical risk and hostile events, which are clearly impacting global supply chains and financial markets, but are likely to have longer-term impacts on globalization as well. And all of that, I'm talking basically about traditional financial risks, credit market liquidity caused by some of these external shocks and then amplified by internal vulnerabilities. But there are also the fact that we are also, and we heard a view on this, a lens on this from Matt's speech, we're also facing operational shocks that are becoming increasingly more frequent. I mean, Matt did talk about the frequency of attacks in terms of ransomware increasing after the events we saw in Ukraine. So it's not only financial risks, it's also operational risks. So I'm very jolly today, aren't I? So this is the environment that I think we are operating in. So what are we doing as the International Association of Insurance Supervisors? What we are doing is we are regularly asking ourselves what these developments mean for the companies we supervise, and what does it mean about what we do. So, as I have said, I think both ourselves, but more importantly, the companies we supervise, should think about how they deal with events that are not in recent history and not in the data. How should they expect the unexpected? And I guess we are beginning to get used to that sort of thing when we're looking seriously at climate risk. So scenario analysis is one way to expect the unexpected, because we haven't seen a climate catastrophe in recent data. But maybe we should start thinking about expecting the unexpected in a broader set of risks. So that's one. Second, working together as a global community, it is very important that we continue to cooperate to try to understand what risks we are facing in different markets, and to try to pull out what are the common risks and what are the differences, and try to support and learn from each other. Third, we need to remain agile and flex our resources depending on the risk landscape as it develops. Again, it's related to the theme of expecting the unexpected. We know financial stability risks can emerge rapidly, and they often emerge in ways that they had not emerged recently. Although, unfortunately, the consequences tend to be very bad, similarly to what had happened before. So all of that suggests that we need to be rigorous in the way which we undertake our risk assessments, both as a supervisory community, as regulators, but also the companies themselves. Now, what have we done as a supervisory community? We came up with the holistic framework, which we adopted in 2019, 3 years ago, and we've used it in different ways to try to look at the risks that our sector is facing. This involved the latest global monitoring exercise, involved 50 supervisory authorities that participated in that exercise. Not only the major authorities, I guess, are less than 50, so the number shows you the extent, but a number of others, because they wanted to contribute and learn from this exercise. And it also involved data from 60 of the largest global insurance groups that represent together the majority of global premia. We supplemented then this very much analytical exercise with regular conversations with CROs and CEOs of the insurance companies as part of our understanding of the risks that they see around and exchanging information with that. So that's what we've done. And we have found that, although the insurance sector still does not pose the same systemic risks as a sector as a whole as the banking sector still remains far more systemic in terms of if it proves non-resilient, what could happen to the rest of us. But the insurance sector's footprint has been going up over the time that we have been collecting data. And you will see the reasons and the analysis for this when we publish our global insurance report next month. Now turning to what we are doing. I mean, ultimately, risk assessment is very good and very important and a great tool for supervisors because you can sort of survey the landscape and then you can stress test your insurance companies. You can see how well they're doing against the risks that you are worried about at individual level. But ultimately, what matters, a very important tool, is the resilience of your sector as a whole. And that's where solvency standards, I mean, they're not the only standards that are important, but in the insurance sector, as in other financial sectors, they're probably the most important. So that is why we are continuing to be making progress on the insurance capital standard. We are completed the third year of the monitoring period, and next year we are going to be issuing our consultation paper for the ICS as a PCR. And that is, of course, an incredibly important milestone that we need to meet. So, in conclusion, as the theme from our conference highlights, we are in a changing landscape, and the insurance sector will have a critical role to play in meeting and being well prepared in meeting these emerging economic and financial and operational risks, but also to help society to meet its challenges. And I will focus on the rest of the discussions in the conference. Lastly, before I finish, I would like to say a big thank you to Gary, who has decided, the chair of the PDC, who, unfortunately for us, has decided to step down as PDC chair for entirely understandable reasons. I'm very grateful for Gary's tireless work to drive forward our policy agenda, and I'm glad he will continue to be involved with the IAIS and continue to be on our ExCo. So thank you very much, Gary. I'll now hand over to Jonathan.
Thank you very much, Vicky, and again, a very warm welcome to everyone. Fantastic to see so many faces, old familiar faces, new faces, but so many people together again in one place. A real sense of community here. And also to extend my extreme gratitude as well to Solange and Kevin and your team. It's been absolutely fantastic hospitality so far, and thank you. I know it is no mean effort to pull these events together, so a very big thank you. I mean, we gather at a point in the week where some of us in the audience have actually been here for 3 days already through some fairly intensive and long meetings of our committees. Happy to say they have been very successful meetings, long meetings, but successful. But we now we pivot our focus to really the stakeholder engagement part of the week. And as I'll come back to later, this really is the key part of the week as well. Before moving on to that, though, I just want to flag, while Vicky really focused on what you might say is the bread and butter of the IAIS as the global standard setter, highlighting our work on capital standards and the holistic framework aimed at maintaining policyholder protection and financial stability. Let me shift gears a little bit to how we respond to two other key strategic themes that affect the insurance sector and indeed the broader financial system. And of course, by that I mean these key global themes of climate risk, financial inclusion, digital transformation, operational resilience, conduct and culture, plus diversity, equity and inclusion. And I thought it was quite striking how the remarks from the Minister of Finance today and the Deputy Governor really reflect the same agenda that we're discussing here at the IAIS. So I'm going to try and do a brief run through some of these themes, and excuse me if I'm a bit brief on the topics. But on climate, I'm happy to report that a great accomplishment this year is that we've completed our climate scenario analysis capacity building work with more than 200 supervisors from around the globe taking part in our workshops, and we will launch 2 consultations next year on supervisory practices related to climate risk, covering topics like governance, market conduct, valuation and enterprise-wide risk management. On fintech, our fintech forum is focused on knowledge sharing of the risks and benefits of digitalization. We're finalizing a report on the use of innovative technologies by supervisors, known as SupTech, and which we're developing with the FSI, so thank you, and the A2II, so thank you for that support. We'll also shortly be publishing a summary of the work that the FinTech Forum has undertaken on artificial intelligence and machine learning, distributed ledger technology and API. So a lot of knowledge sharing on practices coming out there. On conduct, our work has highlighted the importance of a more forward-looking and outcomes-based approach to supervision of conduct risks and the links between consumer protection and prudential policy. And we're finalizing our work on key indicators of conduct risk aimed at supporting a more proactive approach to conduct supervision. On operational resilience, we launched a consultation on a paper that highlights operational resilience issues in the insurance sector and provides examples of how supervisors are approaching these developments, taking on board lessons learnt during the COVID pandemic. And importantly, on diversity, equity, and inclusion, particularly happy to report that we have crystallized our commitment to D&I within the operation and governance of us, the IAIS ourselves. And you might have seen that we've just published on our website a statement about, firstly, the value we place in D&I, secondly, why we consider it essential to the IAS being able to accomplish its mission most effectively to incorporate D&I, and the ways in which we are going to continue working to further improve our D&I going forward. We will also shortly be publishing a report on the stock take that we've done on insights into the activity underway by both insurance supervisors and others, including the industry, to promote D&I in the insurance sector. That was a bit of a whirlwind, and of course in a few minutes it's not possible to consider the richness of the IAS's myriad efforts on these topics, and that really is why the engagement over the rest of today and tomorrow in our panel discussions is so important. So I look forward to those. So Vicky highlighted the stark challenges our sector is currently facing. And I do think it means that supervisory cooperation and collaboration is even more important now than ever in these volatile and changing times. This is a clear lesson from our response to the COVID-19 pandemic, and it will be what guides us going forward. The IAS provides an effective platform, I dare say the only effective platform for engaging on adequate supervisory responses to what are increasingly global issues impacting the insurance sector. Of course, as I said, many of these factors also impact the financial system more broadly. So that's why we are an important part of the broader financial architecture, and we engage in particular with the Financial Stability Board, the FSB, an active member of the FSB, trying to bring an insurance sector perspective to those financial stability discussions. And to seek closer cooperation with other international forums to understand the spillover effects of any developments in the financial system more broadly, both to the insurance sector and from the insurance sector. Specifically, it is through our global monitoring exercise that Vicky mentioned that we are able to bring this insurance sector perspective, as well as our collective discussions that we have on the outcomes of the GME. And I can say, we confidently say that we believe that the holistic framework and the GME provides a far better approach to addressing financial stability risks and systemic risk issues in the insurance sector than the previous GSI approach. Before I finish, a quick note to acknowledge that much of this work is only possible because of the commitment and dedication of what is actually quite a small secretariat team. I want to thank all of them in the team for their continued steps to make our work even more effective, from the significant improvements to our website and our brand, which I hope you enjoy behind me, to the move back to in-person meetings, and the fact that this year we've had more than 70 stakeholder engagement activities. And stakeholder engagement, to link back to my first statement, really is key, and it will remain key for the IAIS. This year, I would flag, we recognize that we do not have perhaps a strong enough voice from consumer groups in our discussions, and so we are looking to address this over the coming years, providing for more engagement with consumer bodies at the ExCo level, in our subcommittees and our events. We'll need to be creative, given limited resources, but it's something we're very committed to. And I want to end on that note, perhaps, to recognize, the same way we've come 2/3 through the week here in Santiago, we also recognize that despite all the hard work that we do to develop standards, to agree on frameworks, and so on, that is only half the work in a way. It's not complete unless we have effectively communicated those changes and how they have an impact and their importance to the person on the street. It's only half the work if we haven't done it with very strong engagement and collaboration with our stakeholders. So that's the message I'd like to leave with you, and I hope you are seeing that difference within the IAIS as well. So thank you very much, and with that I'll hand over to Dieter.
Thank you very much, Jonathan, and also from my side, of course, a warm welcome to Santiago. Now, from MPC's perspective, it's been a crucial year. This year marks our third year of the implementation of the holistic framework, and as such, we're nearing the end of a first 3-year cycle. We found that the framework is significantly more effective and robust in assessing and mitigating the build-up of systemic risk in the insurance sector. And I think that's a very positive message, a message which Jonathan highlighted earlier as well. Now, as many of you know, next month, the FSB, in consultation with IAIS and the national authorities, will decide on the need to re-establish the annual identification of the globally systemic important insurers, or stick to the holistic framework. And our input, our own assessment of this framework, will of course be a crucial input to the decision of FSB. Let us zoom into this year's global monitoring exercise, which is one of the key pillars of the holistic framework. From the 2022 global monitoring exercise, and comparing our own data with that of the banks, we can conclude that on aggregate, systemic risk scores in the insurance sector remain significantly lower than those in the banking sector. However, we do see a rising trend in total systemic risk scores in the insurance sector, mainly caused by an increased interconnectedness of insurance with amongst themselves, but also increased interconnectedness to the broader financial sector and the real economy. We have also observed increases in illiquid assets, more complex over-the-counter derivative positions, and an increased use of cross-border reinsurance. Coupled with the gloomy macroeconomic outlook, which previous speakers have already hinted to, coupled also with the uncertainty and the volatility in financial market, this means there is no room for complacency. Therefore, the other pillars of the holistic framework, namely the supervisory measures in which we, for instance, target liquidity risk, but also promote the setup of recovery and resolution plans, as well as the robust assessment of a consistent implementation of the holistic framework, remain of utmost importance. Peter Braumüller, the chair of the IAC, will share more about that later on. We will also be reviewing certain ICPs and ComFrames. So the first 3 years of the holistic framework have also shown us where there is some room for improvement here. We have identified certain issues where there is room to be more clear and where there is also room to avoid unintended consequences of the wording of certain ICPs and ComFrame standards. For instance, related to resolution planning, where the supervisory measures are not yet applied at the level of certain individual insurers, we will follow up on these issues through the global monitoring exercise and the collective discussion process. We will also continue to refine our global monitoring exercise. We will be collecting your input in a public consultation on the individual insurer monitoring, or IAM, and more particularly on the assessment methodology that we use. We will launch this next month. Overall, the IAM assessment methodology has proven again to deliver robust results, which is why currently we're not looking to make significant changes to the methodology, but refinements will be considered, for instance, through increasing the granularity and consistency of the reporting of some of the indicators to address some of the trends identified in this year's GME. I very much encourage all of you here present to participate in that consultation. Now, in terms of macroeconomic risk and developments, we've had our collective discussion at the level of IAIS in September. And within that collective discussion, we have focused on 3 key risk themes. First, the lower macroeconomic outlook and the high inflation environment, in which we tried to assess the impact on insurers of rising inflation, tighter monetary policy, volatile financial markets, and increased credit risks. And linked to that, we've also discussed the supervisory response, which we ourselves as a community of supervisors should consider. Linked to that, we know that the combination of these factors are not neutral when we look at liquidity risks. So the development of a liquidity metric, which we'll come back to later, is a crucial element in this part of our risk discussions. Secondly, we've also been monitoring activities and exposures commonly linked to private equity ownership of insurance business. This includes trends which we have spotted on significant increases in cross-border reinsurance, highlighting to some extent potential concentration risk and regulatory arbitrage, and an increased asset allocation to complex illiquid investments. More importantly, these trends were spotted in the broader global insurance community. So they're not only linked to private equity-owned insurers. This is also a lesson learned which we will take forward. Lastly, on climate-related risk, the risks to insurability, which was highlighted as one of the main transmission channels through which climate-related risk in the insurance sector could impact the broader financial system and the real economy, also deserve a supervisory response, and it's also something which we will take up towards the future. I would like to invite all of you to read the highlights of our collective discussion and on each of these themes in our Global Insurance Market Report, which we will publish in December. We will also continue our progress on our work on the GMAR special topic on cyber risk, which will focus on how cyber operational risk can impact financial stability, how cyber insurers can help mitigate or amplify this, and how we could monitor this risk on a more structural basis in scope of the global monitoring exercise. This report you can expect at the beginning of next year. Finally, and I've already hinted towards it, we will publish our liquidity metrics next month. These liquidity metrics, which benefited already from feedback that we received through previous public consultations, will enhance our capacity to monitor liquidity risk as an ancillary indicator in scope of the individual insurer monitoring. The finalization of this multi-year project could not be more timely in an environment where, as we have already said, markets are very volatile. We see, for instance, that the impact of increased derivatives and the related margin calls related to these derivatives position linked to sudden rises in interest rates could cause issues, and we've seen some issues in markets lately. We will start developing further ancillary metrics as well, so we will go beyond liquidity, for instance, on credit risk. And this is work which we will carry on next year. Now, this concludes my update as MPC chair, and I'll pass the floor to our PDC chair, or previous PDC chair, Gary.
Thank you very much, Dieter. I'm always impressed with how he's able to juggle the differing responsibilities that he has and how they impact our broader market. And thank you to our Chilean colleagues for hosting. As I said in Dubrovnik, it's really, really nice to see most of you. I am from Boston, but I actually grew up in Idaho, so there was something about when I got here, something about those mountains that felt like a comforting blanket. Probably also explains, because there's some other similarities, why I completely slept through an apparent earthquake. But as Dieter noted, the Policy Development Committee and its subcommittees have made good progress on supervisory and supporting material related to several of the IAIS strategic themes, as well as the Insurance Capital Standard, which you're all familiar with. Next year, we'll reach the critical stage for the ICS with the launch of the public consultation on ICS as a prescribed capital requirement, or PCR. That'll be mid-2023. Feeding into that consultation, the IAIS will agree on any revisions to the ICS to include in the fourth year of the monitoring period, so the data can be collected on what is viewed as an ICS fit for implementation. The mid-year consultation will also include recommendations on additional reporting elements, for example, gap plus valuation and other methods of calculation of the ICS capital requirement, such as internal models, and whether they should feature in ICS as a PCR. The review of ICPs 14 on valuation and 17 on capital adequacy and related glossary terms is underway as well. The public consultation on the draft revisions to these ICPs is planned for Q3 of next year, and the adoption of the revised ICPs is planned for November of 2024. The IAIS is also developing an issues paper on the role of policyholder protection schemes in resolution in order to provide an updated overview of the global practices around PPSs and their role in the insurance resolution. Public consultation on the paper is planned for early next year. Kudos to Alex Hart for his management of this work stream. And last month, the IAIS published for consultation its draft issues paper on insurance sector operational resilience. The paper sets out examples of supervisory approaches to issues impacting operational resilience in the insurance sector, focusing in particular on cyber resilience, IT third-party outsourcing, and business continuity. The consultation will close on the 6th of January. And as part of that consultation, we're also seeking some feedback on targeted questions that will be used to inform potential future work on this topic. We're also progressing work on issues around governance, culture, and conduct. And let me highlight some of those key projects that are within that purview. And the first is diversity, equity, and inclusion. Next month, we will publish a stock take report on the activity of insurance supervisors, the insurance industry, and international organizations to promote DE&I in the insurance sector. And while there are many differences across jurisdictions, the report finds DE&I be a topic of increasing importance to supervisors and points to certain challenges that further IAIS work might helpfully be directed at. This report has a focus on issues related to corporate governance and culture and conduct. And maybe if you'll indulge me for just a moment, just a few minutes ago, I was showing Dieter that my mother was texting me, almost as a signal, as a reminder. And so as I look around the room and I see Vicky and Petra and Susan, Marlene, Kathleen, Lori, Clora, Rachel. I promise I wouldn't do that. The influence of those voices on our discussion are tough to articulate clearly. But they are influential, and I'm very appreciative of how they've influenced my own life, our decisions here at the IAIS, at the NAIC. So I encourage us to continue to to bring everybody in. And the more voices, the better. Maybe I'll hold it together for the rest. The Market Conduct Working Group is working on sharing various approaches to using data and key indicators with the goal of becoming more forward-looking and outcomes-based in the supervision of conduct risk. On climate-related risks, and I want to say here, Daniel, kudos to you for how you've managed this in such an expert fashion with so many stakeholders across the globe. Several PDC committees have joined forces with the Climate Risk Steering Group to deliver on our ambitious work plan related to addressing climate risk by enhancing supervisory practices. Here we've made progress on limited changes to ICP guidance and the development of supporting materials on a wide range of topics. And this will be consulted on next year. So with that, thank you again, and thank you to our colleagues here in Chile, and I will hand it over to my friend, Peter.
Thank you, Gary. Ladies and gentlemen, colleagues. Last but not least, I'd like to update you on what was a very productive year for the Implementation and Assessment Committee as well, and share with you some of the highlights of this work. We recently finalized our assessment of the implementation of the Holistic Framework Supervisory Material, and as was already said, we are going to report the results to the FSB in the coming weeks. The Targeted Jurisdictional Assessment, or TJA, results demonstrate overall good implementation of the framework standards, and where there are gaps, in particular in the area of recovery and resolution, progress is being made on implementation in most cases. We will publish a report on the TJA results in the first half of next year. Going forward, we will ensure that continued implementation monitoring of the framework supervisory material is in place, with a particular focus on identified gaps in implementation and the consistent application of those ICP or COMFRAME standards that are applied by national authorities on an, as we call it, as necessary basis. For example, resolvability assessments and resolution planning. Secondly, our member assessment program reviews the legal structure, regulations, supervisory policies and practices in our member jurisdictions. In July, we could finalize an assessment of Mexico's ICP implementation, noting a substantial investment in strengthening insurance regulation and supervision, while further improvements have been recommended to move towards an even higher level of observance with international supervisory standards. And we are currently engaged with the assessment of implementation in Albania, where we hope to finalize the report by mid-2023. Lastly, on the implementation assessment front, we continued our successful thematic peer reviews with a process on ICP 9, which is on supervisory review and reporting, and ICP 10 on supervisory measures, corrective measures, and sanctions. We had a record number of 86 IAIS members participating in the exercise, highlighting the clear interest of IAIS members on this tool. The assessment report will be published early next year. And following that, later next year, we will start the next peer review exercise, which will be on one of our key standards, which is ICP 16 on enterprise risk management. During the year, we also enhanced our support for effective peer exchange, capacity building, and supervisory cooperation, another key element of the work of the Implementation and Assessment Committee. And here I would like to acknowledge the invaluable support of our implementation partners, the Access to Insurance Initiative, the Financial Stability Institute, the International Actuarial Association, and the Toronto Centre, who supported training and capacity building of supervisors from all regions on a broad variety of topics. Moreover, working closely with the regional coordinators, we supported, after a long time of only virtual meeting, also in-person regional seminars in Asia, the Middle East and North Africa, as well as in Latin America. This year also saw continued expansion of the IAIS peer exchange forums. We now have 6 forums with members from more than 70 different supervisory authorities, which help facilitate understanding of supervisory issues, emerging risks and trends, and support sharing of good supervisory practices. The 3 new or updated forums now we have are the Supervisory Forum, the Financial Crime Forum, and the Risk-Based Solvency Implementation Forum. Meanwhile, the Financial Inclusion Forum has continued to go from strength to strength and facilitated knowledge exchange on digitalization, climate change, and rising protection gap and disaster preparedness. Meanwhile, the Retirement Income and Pension Forum considered the macroeconomic outlook, longevity risk, financial literacy, and climate risks, and what it means for the pension business. On the basis of the recently published joint IAIS Access to Insurance note on the pandemic protection gap, we have agreed to continue work on protection gaps focused on the role of supervisors in relation to natural catastrophe and protection gaps. And finally, in 2023, we will review our application paper on inclusive insurance to reflect different approaches to financial inclusion, increased innovation and digitalization, and other trends and developments since its original publication a decade ago. This concludes my report on what really has been a very exciting and productive year also for the ISC, and I hand back to Jonathan.
Thank you very much also to all our parent committee chairs, and I hope that gave you a fairly rich sense of what's been a busy year. Good. Now we will open up to the Q&A part of the town hall, and we'll turn to audience for questions. When it is your turn, if there's a roving microphone that goes around, if you could stand and also give your name and the organization you represent. Before opening up more widely, there are a couple of pre-submitted questions that we have from our some of our key industry association and other stakeholder partners. So first of all, I'd like to turn to the Global Federation of Insurance Associations, JAFIA, and we have Susan Neely with us. And first of all, congratulations, Susan, on your election as president of JAFIA yesterday. But over to you.
Excellent. Well, good afternoon, and thank you. In my day job, I am the president and CEO of the American Council of Life Insurers, but was very honored to be elected the president of the Global Federation of Insurance Associations just yesterday afternoon. So I will try not to fumble the ball here in my first official act as the president. But we do appreciate the opportunity to be here to learn from you. And as always, we appreciate any opportunity we have to give feedback. With your permission, 2 questions today on topics that have been cited again this afternoon with updates that are priorities of yours and of keen interest to us and priorities to us as well. The first, it relates to international capital standards, and we know you have a session on this tomorrow, but we're looking for anything you could share today regarding what we're concerned about is the feasibility of the timeline and stakeholder engagement. I think the lesson from JIFIA member experience in our own countries with the consultation on comparability criteria throughout the summer is that stakeholders need background information and sufficient time to be able to provide meaningful feedback. We're very keen, the industry is very keen on contributing through the public consultation, as cited, beginning mid-year next year. And we just think it's important that stakeholders have information on how the proposed calibrations were chosen and that we have sufficient time to reflect on that. So curious what your thinking is in that regard on timeline.
Can I hand to David on that one? Thanks.
Sure. Thanks, Jonathan. And Susan, thanks for the question. And I'll echo Jonathan's congratulatory note for yesterday. So looking forward to working with you in both of those capacities, your day job and now your, what I jokingly called this role, my night job. So looking forward to that.
Or very early morning job.
Or very early morning job, true. So just in terms of the overall timeline, we're still on track to deliver the ICS by the end of 2024. So just we'll note that. And I would say that, you know, we just recently wrapped up the consultation on the comparability criteria. We got a lot of good feedback. And as a result of a lot of that feedback, we have decided to provide some additional opportunity for stakeholder input, and especially with respect to the development of the scenarios that we're going to be utilizing in that process. And so I think there's going to be a lot of opportunities, as you noted, to weigh in on that. Those have already started back in October. And they'll continue throughout the fall and winter as we work towards this. And then obviously we're going to continue to look forward to your all's feedback on the consultations as we publish those. With respect to the consultation on the ICS as a PCR, I think we do recognize that that one is going to be significant. And so we expect to provide 90 days for feedback on that one, which I think is longer than what we typically do, so that you all will have the opportunity to be thoughtful in your responses to us on that.
Thank you very much. The second question relates to both protection gaps and diversity, equity, inclusion. We've been very pleased to see that some of the national and regional supervisors are looking into the issue of protection gaps, and we at Jiffy are doing our part. We spent most of yesterday focusing on a study that we've spent the better part of the year on as it relates to major protection gaps, and look forward to sharing the results of that analysis with you early next year, and hope it's helpful in the sort of collective spirit of it. But I think, as Commissioner Anderson noted, there are differences in terms of protection gaps and diversity, equity, and inclusion. How do you all see, how does the IAIS see the interlinkage between protection gaps and diversity, equity, and inclusion?
Thank you, Susan. I think Shigeru? Great.
Thank you, Jonathan, and thank you, Susan. And I also congratulate you on your new role, and I look forward to working with you moving forward. And actually, this issue is most appropriate to be answered from Helen Rowawatt, our DE&I champion, who has demonstrated excellent leadership and produced really significant, meaningful deliverables so far. But unfortunately, she has not participated here, so I will answer on her behalf as a vice chair on this. And as Jonathan has mentioned, I think the DE&I is very much important for the IAIS, and we have published our statement today on the value we attach to it and how we think that this is an important issue for the IAIS and the way forward. And we have also working on stock-taking exercise, trying to collect from supervisors' practices, and we will publish this very soon. And also, I'd like to highlight that we are also very much interested in how the industry is working on the DE&I perspective, especially looking at the internal governance of each firm, but also how you engage with the customer base in this context, given the diversity of your customer base as well. And your question on, you have mentioned your question about how does this relate to the natural disaster protection gaps, which we are actually focusing on right now. And this work will be quite important for next year, as we are undertaking work on this, focusing on natural catastrophes and the risks of increased protection gap. And as your question suggests, it would be worth for us to consider any DE&I aspects that arise in this context. Indeed, the UN International Women's Day theme of 2022 recognizes that women are more vulnerable to climate change impacts and disaster risks than men. So there is, I think, a link between the two that you have mentioned. And I think it is also very important to note that the A2II is very active on this issue related to gender attributable protection gaps, and the IAIS will continue to support this work. Thank you.
Thank you very much.
Thank you, Suguru. Thank you, Susan. Now we'll turn to the Institute of International Finance, the IIF, and I believe we have Mary Francis. There we go. Thank you.
Very much, Jonathan, and thank you for holding this this town hall meeting. My question relates to fintech. With insurance business models becoming increasingly data-driven and digitalized, regulators have turned their attention to the ethical use of data and advanced data analytics in financial markets, including insurance. Jonathan mentioned an upcoming report on artificial intelligence, machine learning, and other innovative technologies. Does the IAIS intend to follow up on this report with specific guidance on the fair and ethical use of customer data and AI and these other advanced analytical tools? And if so, what's the preliminary thinking on these topics? Thank you.
Great, thank you. Well, with that, I can turn to our FinTech Exco champion, Petra Hilkema from IOPA. Thank you, Petra.
Yes, thank you, Jonathan. Thank you, Mary, for the question. Great to see you. Great to see you all. And thank you for allowing me to say indeed a little bit of the work that we want to do. So I think we've done, with the help of many in my forum, an assessment of what we see happening in our markets. It's really a forum that shares, that has fed into reports that we've shared with our members, and a smaller version of that, which we can share publicly, will come out at the end of the year. We hope in the week of the 12th of December. We hope together with also a subtech report, so do watch out for these publications. I think it is an interesting read, and what you will find there is what we see happening in AI and also in the other fields, so machine learning, blockchain, APIs. At the same time, and we discussed this with EXCO of IAIS, when we look at what we want to do next year, I think we clearly identify that particularly in AI, a lot is happening, not only in the market, but also from a supervisory perspective. Does that mean we start drafting guidance or immediately? That would be a step too quick. That would also probably be with another committee that does the official guidance drafting. So where we are now is that we as a forum next year will do a stock take of regulatory initiatives that we see around the world currently on regulatory frameworks or other means for supervisors to actually address AI and the use of AI by insurers. And that in itself should inform where we are at a global level, but also what then could be done from a supervisory perspective at the global level to indeed, where possible, ensure at the early stage a level playing field.
Thank you very much, Petra. Very helpful.
Thank you. Then we'll turn to our last question before opening up, and that is from Roseanne Harris, President of the International Actuarial Association. And Roseanne, very nice to see you again.
Thank you so much, and thanks for allowing us to be part of this event. I guess in keeping with the theme of a changing landscape, the IAA has noted that there's a possibility of broadening the scope for insurance covers through the use of alternative pooling mechanisms, so like public-private partnerships and community-based arrangements. And these are certainly starting to emerge. So we certainly see the opportunity for these mechanisms to sustainably address some of the protection gaps that have emerged during COVID. But of course, there are some supervisory challenges around aspects of these mechanisms. So we wanted to ask whether these supervisory challenges are under consideration. We're thinking of challenges such as capital, market conduct, data protection when it comes to these less formal arrangements, and whether our profession, the actuarial profession, can be supportive with regard to work in this space. Thanks.
Thank you very much, Roseanne. And let's see, who's Shigeru? Perfect.
Okay, thank you very much, Roseanne, for your question. And indeed, protection gap, especially we're focusing on natural disaster, but this has been a growing trend, I think. It's an alternative, seeing a range of alternative, including seeing a range of alternative pooling mechanisms. And I think what would be important moving from here is that these are examples of a sort of a sharing of the load between the insurance sector, governments, and the consumers. And for IAIS member supervisors, we already, as you know, have mandate to consider implications to the risk or controls and the balance sheet resilience of licensed insurers from their participation in such arrangements. And the IAIS has included in its work program for 2023 a project that will investigate the role of the supervisors in addressing protection gaps. And as part of this work, we envision looking at solutions such as PPPs, and will consider whether insurers' participation in such arrangements will benefit from further supervision and regulation, and if so, the challenges and implications of doing so. So we're quite open, but we are open to discuss what kind of implications or challenges there will be for us. So we'll also be exploring this. And the focus of our work will be on natural catastrophe protection gaps, and we will look to draw on the experiences and expertise of our members, as well as input from our other partners. And let me highlight some work that the A2II has done in this regard in conjunction with the IAIS on pandemic protection gaps that considers some of the issues that I have mentioned. And one point that was highlighted here was that not always that supervisory authorities were involved in the early stage in perhaps developing PPPs in the real world yet. So one idea, maybe one challenge could be to ensure that supervisors are appropriately involved in the discussions around the design and the implementations of such programs. So, but this is just one aspect, but I think it's an important one. And generally speaking, our ICPs are universally applicable to the supervision of all types of insurance business and all types of insurance providers. That said, it may be somewhat premature to comment on specific implications that it would have on these arrangements. So we are at the initial stage, and we look forward to exploring what will be the implications and the challenges that lies ahead in this new work. Thank you.
Great, thank you very much for those questions. And now let's open up the floor to see if we have some other questions. I think we had a hand up right there on the second last row. There we go. And if you could, again, introduce yourself and your organization.
I will. Thank you. Good afternoon. I'm Bernie Birnbaum with the Center for Economic Justice. We're a consumer organization, so I'm here as a consumer stakeholder, but we work with consumer organizations throughout the U.S. and Europe through the Transatlantic Consumer Dialogue. So I have two questions. The first starts with a thank you for your beginning steps in improving your engagement with consumers. We appreciated the dialogue we had a few months ago. So the first question will be, what will be the next steps for improving consumer engagement and expanding that? The second question deals with the financial risks that Vicky talked about and others have talked about to date. You talked about the economic indicators, you talked about inflation, and talked about the financial risks that insurers face because of these economic shocks. And I wanted to suggest that there's a conduct of business risk associated with each one of those shocks. As inflation rises and consumers face higher costs and seek higher returns, there's a great potential for abuse in the sales of products that falsely promise those higher returns. When insurance companies are faced with higher inflation in the claims settlement of general insurance products and are looking for ways to sort of cut costs or cut corners or preserve their profitability, there's danger for unfair claim settlement practices. So I wanted to suggest that the metrics that you're looking at, the financial metrics, are really trailing indicators of problems that can lead in combination to systemic risk, whereas the conduct of risk indicators are really the preliminary indications of that. By the time you see problems with liquidity, there's already an issue because it's baked into the outcomes. If you're looking at unfair claim settlements, the number of claims that are denied that have shot up, or the number of applications that have been rejected, or any of the other indicators that you might look at on the conduct of business side, those would be leading indicators. So my question is, in your global marketing exercise, what have you done or what do you include in terms of conduct of business indicators as part of your global marketing exercise, and what do you plan to do in the future to include conduct of business as you approach these systemic risks? Thank you.
Thank you very much, Bernie. I think that's a sort of multifaceted question, so I may ask Dieter to talk a little bit about the global monitoring exercise aspects, and Gary to talk about very much, I think as we've said, the work that's being done on key conduct indicators, I think is key. There's interesting links there to the SupTech work. I mean, to your point that having timely sort of proactive indicators of conduct risk can be very helpful. That technology can also help with that. But before handing over to Gary and Dieter, there was also a question on the IAIS operational side of our stakeholder engagement with consumer bodies. So I think likewise a very big thank you to you and other consumer bodies who met with the leadership of the executive committee a month or two ago. I think there was a very good kickoff meeting, and I think we've committed to work together to come up with some next steps, and I know Joe is working on that, but certainly I think it would cover all of the areas that I mentioned in my address around sort of regular contact at the executive committee level, but also making sure that there are opportunities for regular, more frequent interactions at the technical level with our market conduct working group, who are particularly mandated with these consumer issues, and also seeing how we can facilitate more structured and also more in-person engagement at our milestone events as well. So we need to think a little bit creatively around that, as I said, given resource issues. But that's been actively discussed, and that's one of the areas that's on our agenda for the first half of next year is progressing enhancements to our stakeholder engagement plan. But I don't know, Gary, would you like to go first?
Yeah, sure. Happy to, Jonathan, and nice to see you, Bernie, in person. So to your point of the trailing financial risk, so this is something that supervisors, I think all of us are increasingly looking to adopt more. I think this may address it, and I'll address it kind of generally, but more forward-looking, outcomes-based approaches to conduct risks. If you'll recall, back in June, the IAIS published a report presenting member survey insights on a variety of supervisory approaches and challenges related to using data and key indicators in conduct supervision. So next, in Q2 of 2023, we'll release, it'll be a members-only publication, but the idea is to feature supervisory examples, case studies, to further kind of help each of us as members with the approach using data and key indicators to supervise insurers' conduct, to your point, a little more proactively. Thanks, Bernie.
Maybe one aspect that I could try to add to that. So if you look at our global monitoring exercise, it's fair to say that to this date we've been focusing very much on the financial stability, macroprudential angle there. So what we're trying to look at is how financial markets could impact insurers, so the inward risk, but also outward risk, how insurers themselves then again could impact the broader financial system and the real economy. From that perspective, the set of indicators that are within the system, are within the system that what you could call related to conduct risk are very limited today. But I think it's something to the extent that conduct risk indicators, which are still being developed, could help us inform us on the broader financial stability. Why not? It's definitely something we could and probably then should also consider. That's work to be done then.
Thank you. Let's open up for other questions. Is that Helena in the back there? Long time no see.
Yes. Sorry, I'm losing my voice, so I apologize, but it's wonderful to see so many colleagues here. Well, simply wonderful. I have a question and a comment regarding common ComFrame and insurance principles specifically. Recently, among us in the industry, when we looked at the progress that we have done over the past decade, the issue of IPPs and qualitative, very tangible progress on governance, risk management, ALM, understanding each other on the regulatory side, I would assume, but also certainly on the industry side, it's a tremendous road that we traveled relative to where we were 10 years ago. So I know that sometimes we are in some ways stuck on ICS and different challenges and comparability, etc. But again, looking at those other aspects, the whole ComFrame, there is so much that we have accomplished. So I just was curious how the IAIS Executive and Secretariat thinks about it, and whether we could advertise more, like take stock of what happened in that decade and where we are and how we see challenges going forward. Thank you.
Yeah, I mean, thank you very much and very nice to see you, and sorry for losing your voice. But you were very clear. You're right that the development of the insurance core principles, which apply to all firms, is a major achievement and continues to be the bread and butter of our supervisory material. we have various tools that try to support our members who want to implement the ICPs or better implement their ICPs to support them, which include more recently member assessment plans, deep dives, and Peter Brown-Muller could talk about those. I mean, ComFrame, as you know, is basically an elaboration of the ICPs for internationally active insurance groups. And within that, the only quantitative pillar is the ICS, which we are developing and planning to consult next year. What within the ComFrame standards, we have also, there are also some standards that apply, that support macroprudential supervision. And those this year, as Peter said, we did a deep dive in major jurisdictions across the world. We call it the targeted jurisdictional assessment on how well implemented this ComFrame, this subset of ComFrame standards are. And I mean, we're going to be publishing our assessment. It was also one part of the monitoring of how well implementing the holistic framework is. But the headlines are that you're right. This, at least this subset of products of our standards has been broadly implemented across the major jurisdictions, and certainly other jurisdictions across the world are very interested in it. So it is a success we should celebrate. Not all standards, subset of standards within ComFrame as well as implemented as others. There are certain gaps. But the majority are well implemented. So you're right, we should celebrate. But none of this detracts from the importance of trying to develop also a quantitative pillar. And indeed, for the major groups around the world, and indeed to continue supporting those supervisors who don't have international active insurance groups, and they're not home supervisors of these groups, to develop their own risk-based quantitative pillars, and we have a program for that. Thanks.
Thanks. And Helena, to your point, I certainly suspect in 10 years' time we'll be celebrating the improvements in effectiveness between of conversations between insurers and supervisors on the implementation of the ICS and equivalent implementation. So good. Hugh, sorry, I think I saw Hugh. I think Hugh was first. So Hugh.
Thanks, Jonathan. Thanks, Vicky. It's Hugh Francis from Aviva. I just want to come back onto the holistic framework, because I think we'd all conclude and agree that it's been a far more effective method than the previous tools. And actually, to be honest, it's actually managed to quite successfully survive the boiling pot, or it's been tested in the boiling pot of COVID in the last 2 years, which I think we can all draw a lot from. I just wonder what specifically you'll be recommending to the FSB and how you think that discussion may go without having a crystal ball. And then coming on to a couple of comments that were made about the economic headwinds, although I can't agree we shouldn't be complacent, I think we also need to be a bit proportionate as to how we consider what the risks we face, because as we've developed risk frameworks, we have as much incentive as yourselves do to manage through those. And I think particularly, I have a concern about maybe jumping on the liquidity concern issue. I think it would be something that we could probably do with having a bit more dialogue and wondering how we may approach that, because the reality is that I think certain companies in certain jurisdictions have seen very extreme movements recently, and it hasn't caused the issue that you might expect, and have managed to do that, and that's a very extreme movement. And I'm just wondering that we have to be careful about liquidity, so I'll just encourage you to do that and think about what are you thinking about liquidity metrics, because I just think that there's a slight danger that we are saying, well, insurers have a problem with low interest environment, they have a problem with a high interest environment, they have a problem with volatility on interest rate environment. In reality, we are pretty resilient, and we are trying to manage these risks. And I think it's just important that we think about how we approach these in a dialogue, so we don't jump off one. Where we have valid underlying concerns, I think it will be good to think about what mechanism we could have that discussion in a forum, such that we can really get to the root of where you may have concerns, then we can go through that. Because I think in reality, we haven't seen those issues arising, although, as you say, we shouldn't be complacent.
Yeah, I'll take the first couple of questions, and then perhaps Dieter could speak about liquidity and what we are doing there and what we are not doing. On what we're going to be recommended to the FSB, I mean, you shall find out, is a short answer. But you have already heard that our assessment is that the framework is working very well. It is effective, and we're going to be sharing our views with the FSB. It's ultimately the FSB's prerogative to decide how they will be using the holistic framework for their assessment of the risks. But we hope that they will recognize how we view them. And thank you very much, actually, for all the stakeholder input into the holistic framework, which we hope will, well, we expect, actually, that it will continue going forward, because it is a part of our assessment, an important part of our assessment, to hear what CROs, CEOs, and other stakeholders think about the themes and the risks that we have spotted. So that's, but there should be, I mean, the FSB is plenary where they're going to be discussing this is going to be happening after soon, so it shall all be revealed. But from our point of view, that we will be sharing some of the input that you heard today. I mean, I did not want to create a sense that we have a sense that the insurance sector is not sufficiently resilient. Indeed, the insurance sector has proved sufficiently resilient through, for example, the COVID shocks. What I was trying to do with my admittedly rather gloomy remarks is dispel any essence of complacency, because it is a changing landscape. And it's not only a changing landscape in terms of the risks, but in terms of the policy support that the financial sector as a whole has had in previous big external shocks. So just to be a bit clearer, during the COVID-19 crisis, monetary policy and financial stability policy in supporting the system as a whole were going into the same direction. Policy rates were being lowered and liquidity was being injected into the system. I don't have a crystal ball, but I suspect that the outcomes might have been different if this support had not been there and not gone into the same direction. This might not be possible to be done. I mean, clearly, you know, inflation is going back, and central banks are tightening. So if big shocks do materialize in terms of financial stability, there will be attention between these two things. And coming closer to both yours and my home, we saw that. And it wasn't the issue, the underlying issue was not the insurance sector, but it was a business very close to the business of the insurance sector. It was pension funds that, that essentially were employing leverage in order to match their books better using investment funds. So it was matched business. It faced a very, very unusual shock, and it created all sorts of market financial instability and dysfunction. And as you know, my institution, it did intervene to sort out the mess, but it intervened in a strictly temporary way, and it did so because of this tension between monetary policy and financial stability. So that's one example of why this time is different. But I did not want to say that there isn't, but just don't be complacent, because the environment has changed, as I'm sure you will share. And Dieter, on the liquidity indicators and risks. Thanks.
Okay, I can be very short. So in terms of what we are doing as IAIS in terms of liquidity, I mentioned the development of the liquidity metrics, which will be coming up very soon. So you should not, I hope, be shocked with the outcome of that. I think we have having 2 public consultations on that, and we have tried to develop an approach where we look both at liquidity from a balance sheet perspective and liquidity from a cash flow perspective, applying also different time horizons. And all in all, I think these should be in line and with liquidity risk management as conducted by the insurance companies themselves. I think that's key. If we say don't be complacent about liquidity, and I'm also referring, for instance, to insurers who are active in derivative markets. We have seen that the exposures have been growing, and from those insurers, we do expect a sound liquidity risk management. I think it's fair to say, and you've hinted it towards yourself, I think we're happy that so far the insurers were not too vulnerable towards liquidity problems, but I think it's our incentive and goal to make sure that that's also like that in the future.
Okay, thank you. Unfortunately, we will have to wrap up now. I'm getting some very strongly worded messages that we've run over time, but I know there are some of you in the audience who didn't get a chance to answer your question. I hope over the course of the panels over today and tomorrow you will get a chance. But we deserve some coffee, and I'll hand back to Gabriel now. Thank you.